Hello and welcome to Jazz After Dark, everybody. How's it going out there? Oh, gotta figure out where we're looking here again. Yeah, just getting done with the hurricane. Oh, that's cool. Um, Join me tonight for something rather unique while we enjoy Stranahan's Rocky Mountain Original single malt whiskey there. I happen to actually really like Breckenridge bourbon. And so I thought, oh, this one might be good. I haven't bought a whole bottle of something in a while without tasting it, but we're going to find out. Ooh, smells good. Grab your favorite drink and enjoy with me here tonight. I'm going to do something a little deep. I spent like the last 2 hours trying to figure out how to simplify this. And so I'm going to do my best. Maybe I'll pop the volume down just a little bit, just in case there. We're going to talk about diversification, and then I'm going to try to simplify the way this is explained with a really cool study. And then we're going to show our portfolios as well, the performance of our funds relative to the explanation that I'm going to give. So if you're curious and you're not a client, you want to see, I promise to share that with you. And by the way, we are not allowed to share hypothetical performance. So this will be our actual performance of our funds. You get in big trouble. So that Titan Invest out there, they got in big trouble for sharing their performance in a not so honorable way, let's say. Well, this smells really good. It's very much like Breckenridge bourbon. Very much. Mm-hmm. Oh, actually, a little bit more cherry in there. If you like the fruits, I like that. Hey, Stranahan, how you doing? Very good, actually. I'd give that like a 85. Actually, I think that's really really good. All right. The first question I'm going to ask is, how diverse should you be? You know what I mean? You have an account, let's say you're a DIYer and you're like, I'm going to build my own portfolio. How many positions should you have? So remember, as I go through this, my background was a fund manager prior to being here at Jazz. And so that's why I'm not as polished as in communication as most people that are on TV and stuff, because I never had to talk to the client. How many times do you see a mutual fund manager go on TV and just talk? If they do, they usually don't sound very good. As you know, you don't have to talk to the client, right? So your job is to sit there and perform. The thing I'll point out is, how often does a fund manager get the opportunity to pick a position? You know what I mean? Like, you think there's just people at JP Morgan or wherever, and they're just sitting in some office way up in the sky, and well, they've got $100 billion, which is small, and they get to pick a stock? You think they allow that? No. So we're going to talk position, location, and then we're going to talk about volatility, right? So what we're trying to do is have the best possible portfolio with the least amount of volatility, okay? So I'm getting back to the question in a second, but do you remember the efficient frontier that we talked about, where you cannot take more risk for more reward forever, right? Like if I said, there's this much risk, but there's this much reward, you might come along and say, I'm willing to take this much risk if there's that much more reward. Okay. And the next guy says, I'll take this much risk for an even greater reward. That doesn't go on forever. What happens is you end up taking more and more and more risk for a condensed amount of reward. It's not linear. So we've done classes on that in the past. The diversity question I just asked, how diverse does a portfolio need to be? In other words, not just how many positions, but where they're located, like a dividend stock versus a small cap growth stock. Do you need 2 of each? Do you need 3 of one and 2 of the other? Like, where's the optimum diversification here? Well, this is studied numerous times. You can look up financial white papers from CFAs if you want. They're really good at doing this stuff. As a chartered financial analyst, I will never be one of those. That is just not something I'm interested in. But they are very smart people that can build portfolios and are really good at it. And so I'm going to try to simplify this. Well, what I've spent the last 2 hours on is, how do I simplify it in the world of stocks, right? How do we boil it down? So here we go. First thing we're going to do is look at how diverse a small cap versus a large cap fund is. And not verse, we're going to do them together. So in other words, if you said, I'm going to build a large cap portfolio, or I just like stocks that are large cap funds or large cap positions, how many should you have? What's the optimum? Is there an optimum amount of positions? Here we go. Okay. So I put both of them on here because you'll see in a second, we're going to compare our portfolios to this. But what we're looking at, essentially, you can think of it this way. If you don't want to learn anything else tonight, volatility on the y-axis and the number of we'll say stocks inside that portfolio fund, whatever you want to call it. So in other words, if you just had one small cap stock, that would be the most volatile or most volatility you can experience. And that data here is not a guess. This data is by selecting each stock and pretending that that is one position. Let me clarify that. So what we said is there are 2010 small cap stocks. Just pick one and put it in the portfolio and pretend that's it. How volatile is it? Okay, get rid of it. Pick another one. Okay, that's a portfolio. Okay, get rid of it. Pick another one. You do that 2010 times to find out your volatility is just shy of 60%. In other words, I can't say it that way actually, but the volatility is the highest that it could possibly be. Well, as you work your way with more and more positions, do you get a linear reduction in volatility? In other words, could I just add all of them? Right? Because here's 5 stocks, 9 stocks, and this just happened to be how the Google Sheets did it. But as you go through 21, 25, and so on and so on, can I just add 500 of them and have no volatility? No. You cannot reduce linearly the volatility by just simply adding more positions. So, all right, a little off topic. So where's the optimum place to be? Well, you can really see that by the time you get into 30 positions, 30 stocks in a fund, well, you're not really lowering volatility anymore until you have roughly 85. See how it smooths out right here? All right. So it doesn't really benefit the average person to have more than 30 small cap stocks if their goal is to invest for returns that beat the Russell 2000 or whatever your small cap index is, however you're going to do that. In the large cap space, same thing. The more stocks you have, the less volatile it is to some degree. But we start smoothing that out right in the same area, right? You could even argue maybe just a little bit further because see the distance between 20% and our line here? It really doesn't go any further down once you get into that 30 stock range, okay? So what does that mean? If you're going to hold large cap stocks, you better have more than 5 of them. Right? 5 is not the most optimum return relative to the back and forth volatility that you're going to accept, right? So really difficult. Now, not everybody is small cap, large cap. We said, what if there are people that want to participate in stocks that are just stocks that don't pay a dividend? Maybe some are large, some are small, but it's a little more of a mixed bag. And compare that to people that want to be dividend investors. I know, of course, a lot of our clients are nearing or in retirement. So I know that we need less volatility. Maybe you're focused on dividends. Okay, let's do that. And okay, so let's take a look. So in the dividend world, if you have one stock, of course, I think you get that, right? One stock, of course, in almost any case, news, outlier events, sudden earnings reports, of course, that's going to be your most volatile scenario. Same thing. As you work your way out here, you can find that there is a very slight decay to the volatility in the 40, 50, 60, 70, 80, 90 category. In fact, most dividend funds out there, I'll show you ours versus DVY. That's like the most popular dividend index ETF that you can use. Well, darn it, they've got how many stocks in there? Look it up. One day they've got 99. Maybe a couple weeks later, they got 101. Look back again, they got 98. And they got 100, right? They're right at 100. It's like it's always there. And cash is usually one of the positions. So for dividend fund builders, or if you want to have a dividend portfolio, you don't have to have that many positions. That's how many positions we have in our dividend fund because why? Can I be honest with you guys for a second? One more drink just to see. If I could be totally honest with you, all fund managers from a retail perspective, meaning your T. Rowe Price blue chip fund manager, your Schwab large cap growth fund manager, the ones that are managed by people, right? They just don't want to hear you complain. And I don't know how to say it nicer. If your fund, let's see, if you have a dividend fund and you're a great stock picker, which none of these people are stock pickers. I'm not even a stock picker. If you have a great dividend fund that has 9 stocks in it, you better know that people that participate in your fund have friends, have been in other dividend funds. Maybe their workplace plan is in a dividend fund that has more positions and is less volatile. And so if you're a fund manager that has 9 positions, you're going to get the phone calls, right? Because there's going to be a lot more back and forth in the portfolio than every other dividend fund out there. So Jazz Wealth, we build our own funds here. We have about 100 positions in our dividend fund. That is the least volatility that I can get for a dividend fund. I will always focus on that above anything else, even though returns are, of course, needed. And I'll share those with you in a minute, right? Because I don't want a bunch of people panicking. And I don't think that's wrong. I just don't want people calling going, oh my God, the market fell 1% and our dividend fund fell 3%. Dustin, what are you doing? Can't have it, right? All right, back. So anyways, that's what you have there. Value versus growth. I put that in here because I know some of you focus on growth stocks only, and some of you are diehard value players as well. You can see that we're still in about that same camp. It happens to just be closer to 30 for the value stocks, and I would argue closer to 53 to maybe 65 somewhere. At some point we're pinching hairs here. You get what I'm saying? You don't want to be in this ballpark. All right. So that is, I got one more for you. Domestic versus international. That's right. So international kind of sucked this year compared to the S&P and the US markets, but we're just off to the races here, so that's fine. And then domestically, right, you can see the same thing. There is some level of lowered volatility if you happen to have a thick portfolio. Build it with many positions domestically, okay? There's some overlap, I understand, because it could be domestic large cap, domestic dividend, yada, yada. Okay, so from a sales pitch perspective here, just ask, all I care about is leave a comment if I'm wrong on this one. I'm happy to take the bullets, but will any other advisor show you what I'm about to share with you? Their performance, right? How's things going? Right? And not every client is participating 100% in every these funds, because naturally each client has a different risk profile. But I do want to share this with you. And again, this is the actual performance. We are not allowed to make up any hypotheticals. And today is, in fact, the end of August. Actually, it's the very last day of August when I'm recording this. So if by chance we get audited by the SEC and they would like to see the data, it's all on the screen, right? I do not mess around with this. Okay. So our dividend fund, like I said, contains at the moment, it contains 100 positions, one of them being a cash position. And it is the most diverse we can be. Year to date, I'm comparing it to the dividend index here. Is it more volatile or less volatile than the dividend index at the moment? It has some backs and forths, but ultimately it is less volatile. Therefore, we are performing better. And these are just price returns. This does not include reinvesting the dividends. That is a royal nightmare to be able to present that publicly and not get in a lot of trouble. So I'm not hiding anything, just that's tough. So one could say, this is the DVY, the ticker symbol. This is their year-to-date performance versus our year-to-date performance. And really, that part's fine, but I'm looking at the volatility. I want you to see that. If I zoom out and we say, okay, well, that's only year-to-date, Dustin. What else do you have? I do want to make it clear that every date is on here, so I don't get in any trouble. This is actually one day behind. You see how nervous I am? I don't like doing this. But anyways, through the life of this fund here, we're at 71.5%, 42. And again, this is without the dividends being reinvested. Our fee, to be honest with you here, is anywhere from 0.5% to 1.5% a year, which maybe we could make more, but that's what it stands. So you get an idea if you want to back out the fees there and say, yeah, Dustin, what about the fees? Okay, go ahead, back it out. Again, Is it more or less volatile? Is the blue line more smoothed out than the light blue line? That's the goal, a really diverse portfolio. Now, DVY is diverse as well, so I'm not going to argue with them, but that's that one. We did large cap. So we talk about large caps and small caps. Year to date, you could probably guess what our best position is, which is the reason for the spread between the S&P and large caps. But for the moment, we're super happy with that one. And volatility here, do you think it should be less than the S&P? I'll give you, that's a good question. Can you have better performance than the S&P and have less wiggling back and forth? Is that possible? Let me think. It is, I don't ever want to say nothing's possible to do, but it is as close to impossible as anything you can do on the planet, right? I mean, really, 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 really next to impossible. So you see the performance, the volatility comparisons there, and that is year to date. If we zoom out, our large cap fund, you can see it doesn't always outperform, by the way. We're long-term investors, so if we find that there's something wrong, we're going to fix the problem. But we're going back to 2018. 2018 or so, slight spread between large cap and the S&P. And we don't have fees for our funds, by the way, so that doesn't really change anything. Now, what did we just talk about with small caps? Would it make sense to have 2,000 positions? If you said, Dustin, I'm just going to build my own. I don't need an advisor. Or, you guys do great. I love you, Dustin. But we're going to just build our own portfolio. Did it make sense to have 2,000 positions in there? Assuming you didn't know about the index, that you could just buy an index ETF. Does it make sense? No. Have you ever looked up some of the small cap index funds? Do they have 2,000 positions? Oh, I just spilled my drink. Oh no, I got too excited. That's it. Show's over. Just kidding. Okay, so no, they don't. Not all of them. So year to date here with the small caps slightly beating the Russell 2000. So we're doing better than the index. That's fine. That's our happy sweet spot. I'll take it. And I do want to point out that this is not, please don't think we're superheroes here. What happened here is we ran into the fire during COVID instead of running away from the fire. I'm a bit of a small cap guy. My passion is the small cap stocks there. So if we're ever going to really show incredible performance there, I know not everybody likes small caps, but this is my forte. So when small caps had issues, I very quickly just went in there and said, okay, there are a lot of great small cap companies that have plenty of cash that are going to be getting money from the government. They're going to be able to survive. We need to be a part of that. And so that right here, this is one of the reasons why we're just ahead of the game there. And I'll tell you, since the end of 2022, we have had more cash in this portfolio now. And that's why you see, for lack of a better word, performance that's helping or still doing well relative to everything else. So I would love to sit here and go, look how good we are. But you have to be able to catch that little keen eye there. Make sure you're looking at the right thing. Okay, and then international here. I've got the S&P in there to show you the difference, right? The S&P is beating international right now. We are beating the S&P International Index that people use to track that. That would be the orange line here. Year to date, just up a tick better than that. And it's been a tough year for the international investors this year have had a really tough go of it, admittedly. Okay, looking long term here, comparing the S&P. Remember, international is not normally something that beats the S&P. You're hardly ever going to find that. It's possible, but that's the comparison there, and our comparison to the other choices that one would have, right? So it's like, okay, Jazz, what's your international fund look like versus my other available options that are out there? Happy to say, of course, that's doing better there. And again, the lesson here is not to go, look at the performance, it's doing great. I don't mind sharing when things go bad, because I think you learn from that as well. Tough times during COVID, we did a lot of classes for clients to go, this is tough. You may have to look the other way while I run into this, because this is an opportunity. And no, it did not look great every single day. So I will not be the cocky fund guy here that says that. I really wanted to help those of you that build your own portfolios. This is marketing. Everybody knows that. This is why I'm here, right? I teach you, you remember me, right? I get it. But it's not for everybody. So I wanted to teach you guys, if you want to replicate or you want to work on being a fund manager, maybe in the future, or you want to do this for your family or something, you just have to know how diverse you need to be. You don't have to have 100 positions. We have over 700. I love it. I eat this stuff up. You can have 30. You might want to have a lot more if you're a dividend investor, right? We saw all of that. And so hopefully that is a really visual way to kind of show you how far you need to push it for the optimum performance relative to the wiggling that you see back and forth. Because if anybody knows anything, I think most of you know volatility is coming. Who can be 100% invested in this market and be sleeping perfectly at night? I don't know. Just look at the mutual funds. They have cash, right? There's a record level of cash in mutual funds. They're no dummies. These are not people that are timing the market. Just take a look over there. All right, I'm going to go get a sponge and wipe up the $6 worth of, $5 worth of whiskey that I just spilled there, and get back to work. Thank you for watching. I hope you learned something. We can do more of this. I sometimes will do classes like this, then step back for a little bit and see, did your eyes gloss over? Did you love it? Should we go deeper? I don't know. Let me know there. Happy to help. And of course, thank you for at least giving us a chance, right? Thinking of us at Jazz Wealth there. And we will see you soon. Adios.